alert.
That's all, yeah.
Just let me know whenever we're good. Bloopers.
Welcome, everybody, to Name Confidential Live.
Nice. Hey, welcome to Name Confidential, episode 43. I'm this week's host, Ryan Redfern, in for Asher Ragovi, who's out studying for the CFA. I don't blame him for wanting the time. I hope he's doing well. Today we have Kenton Kilmer from Addigence. Addigence is a little bit different than what we usually have on in the active manager space. He's more of he looks for managers and aggregates them. So we'll dive into that a little bit later. But that's going to be an interesting, different angle on the active management discussion that we usually have. So let's start off with sharing the name exposure index. Of course, it's missing now. There it is. Boom. All right. Should be seeing the name exposure index, which is now at 80.82, which is still pretty positive. A couple of weeks ago, we had Jan Naismith talk about how anytime the index, our name index is above 80, that's usually a pretty good time to be invested. So that's an interesting take that he had. Although I also like, I can't remember the other one. When you see pullbacks below 60 is also a good buying opportunity. So that was a good angle. But I think I was right in there with 82. Certainly was a surprise after post-election and even the Fed that we had quite a jump. So it's good to see that we're all still invested in the market. All right, so on to Kenton. Hey man, good to see you. I've known Kenton for a while, seen him around the name conferences for years. Always good to talk to you. So let's talk about you. What do you do? Give me something about your background and Addigence and what we're going to talk about today.
Hey, that sounds great. Thanks so much, Ryan. And yeah, break a leg, Asher. We're rooting for you. That's no small achievement. So thanks for filling in for him, Ryan. Yeah, here at Addigence, we're an investment manager marketplace. A lot of the times for the name folks, you can think of us as
your background and Addigence and what we're going to talk about today.
Hey, that sounds great. Thanks so much, Ryan. And yeah, break a leg, Asher. We're rooting for you. That's no small achievement. So thanks for filling in for him, Ryan. Yeah, here at Addigence, we're an investment manager marketplace. A lot of the times for the name folks, you
needs to
can think of us as
your background and Addigence and what we're going to talk about today.
Hey, that sounds great. Thanks so much, Ryan. And break a leg, Asher. We're rooting for you. That's no small achievement. So thanks for filling in for him, Ryan. Yeah, here at Addigence, we're an investment manager marketplace.
I don't know what's happening.
For the name folks,
Turn off your volume or mute yourself.
You think of us as background and Addigence. Hey, that sounds great. Thanks so much, Ryan. And
I can't mute Susan. She needs to mute.
We're rooting for you. That's no small achievement. So.
Fuck.
Mute yourself, Susan.
Now I know how everybody feels when I interrupt and speak over them.
No, it's I really need Susan to mute because I can't do it.
No worries. You want to crack on? It seems
we can
like
try. We'll try. We're gonna hear ourselves pop on again here. So go ahead.
What the shit?
So yeah, a lot of the times for our name audience, we're thought of as like a multi-strategy RIA. We specialize in serving family offices and institutions for being able to identify and invest in emerging managers. Emerging managers generally defined as sub $500 million in assets under management, whether or not they are operating under the RIA structure as supplying strategies and signals or as an exempt structure. And that's so this product comes out of a background of investment banking where we specialized in selling emerging managers into institution and family offices and dealt with a very cumbersome, high friction sales cycle that a lot of us in the sales and marketing cycle for asset managers, for hedge fund managers and other liquid alternative managers know too well. And we saw an opportunity because there is demand from both sides, both suppliers of investment expertise and buyers of that investment expertise for a more seamless and frictionless way to interact with each other, while still compensating the suppliers of that investment expertise as they would if they were running performance fee model.
Nice, nice. So how did you get into that space? I mean, you gave a little bit of overview, but how did you get into this space in general? It's certainly a different niche.
I mean, so New York, Manhattan is where I grew up and was born, and so I really, this has been very much sort of the environment of looking at how, alternative investments and how, hedge fund managers have been able to, create really powerful businesses over time, and the interest in wanting to build my own track record. I'd spent 5 years in China at the beginning of my career in the commodities and heavy industry space. I had built up a certain level of expertise in materials industry and heavy industrials in East Asia. But it was very difficult to build a track record. It was very difficult to be able to stand up a fund and investment vehicle. And I said, there's got to be a better way. At the same time, I was working at a boutique bank, doing this at the same time and seeing the frictions, and took a step back and said, hey, instead of building a way for me to, an inexpensive way for me to build a track record and collect fees for profiting off of this expertise and stock selection, why don't I do this for everybody? And so we pivoted and became a technology company providing this platform.
Nice. No, that is quite a shift, but I do understand the, wanting to do better or always seeing an opportunity where something's just not working as it should be. And there's always opportunity in that, and trying to find a new way to bring exposure or things to market that other people aren't doing. I think you guys do a really neat job of it, and the platform is very cool. So I'm glad you're taking that space. So you wanted to talk a little bit about how you identify managers and even alternatives. We talked about that a little bit earlier.
Yeah, I think, one of the secret sauce that we have is we look very closely at how we can automate the institutional limited partners associations due diligence processes. We see them as really a beacon of knowledge of what's the best way for portfolio construction, diligence on alternative investment managers. So it's a rigorous DDQ process, but turning it into a way where it's accessible and real time and done in a platform, so that, when somebody fills out or somebody does the work in order to answer the questions, okay, why this strategy, why this team, why now? We're doing that in a structured way, so that every part of answering those three questions is like, all right, well, you've got a strategy that looks like this is something that's going to be able to be repeatable for the future. What are the skill sets and what are the diligence requirements up to that ILPA, Institutional Limited Partners Association standard, that will continue to foster that expertise going forward? So I'd say that's one of the first things to look at, because it's pretty broad. We have quantitative managers that obviously really sharp mathematics focus, looking at could be statistical arbitrage or other mean reversion strategies. And so showing and highlighting the managers have that expertise to be able to consistently outperform, as somebody might start with an initial allocation of, let's say, 500 grand, and then move up into the millions and make that more and more a significant part of their alternative investment strategy.
Right. And you talked about the due diligence that they have to go through to get that done. And that's hard for a small manager to do in some cases. It's certainly a big hurdle. Are there ways that you found that makes that easier?
Well, I mean, certainly when you're able to transaction in a fraudless environment, that's like a big one. I mean, we're not the only company doing this, but really leaning into democratizing, without getting so kitschy, separately managed accounts. A lot of times we see if somebody wants an SMA, it would be $10 to $20 million minimum, just for the amount of burden it takes for the manager in the emerging manager space or in the established manager space. And we said, hey, well, there's so many benefits to that end client, where they're not that additional diligence hurdle that goes along of like basic stuff like, is this the next Bernie Madoff? Is this the next scam? Hey, at least I know that my assets are being custodied in my own name, and it's not like I'm sending a wire off to, a third party. So when we think about chipping away at the diligence process, making it more streamlined, it's about focusing that attention into why is the strategy doing well? Why is this manager going to continue to do well implementing that strategy with that background, and why that might work in a more macro environment. That's kind of a simple way of looking at it because there's other factors, but the bandwidth of being able to focus on strategy, on performance, on replicating that performance, rather than, hey, who's your fund admin? Who's your legal counsel? Are we sure that this is buttoned up enough? I get an 80-page PPM. Suddenly I got out 10 grand just to pay somebody to read that sucker.
Yep.
We think that's a frictions in the sales cycle we're solving here at Addigence.
Oh, 100%. No, it's having been through some of that stuff myself, I absolutely understand. It's a huge headache. And if you're a small 1 or 2 person shop that's good at models, that's a big waste of time. It's big time suck and big money suck from your day.
What it makes me think of, Ryan, is also, we think of it, and especially at NAAIM, we're looking at it from the portfolio manager's perspective. I think what we can extend here is to empathize with the end client who has to manage, if they're interested in investing across a number of strategies, let's say a stable of strategies. Sure. Each one of those is a GPLP relationship or an SMA relationship that needs to be managed off on a one-off basis. And that's incredibly laborious. So being able to have a consolidated dashboard that has that analytics on an individual strategy basis, as well as a stable level analytics, is a single point solve, so that you're not managing and going into multiple portals for multiple, strategies you're involved in, and trying to unpack it all on your own, which in very much is the work of, OCIOs. So we see ourselves in helping and being a great tool for OCIOs and other type specialized consultants doing strategy construction.
Right. No, love that. So how about on the other side of that, people who are looking to buy these kind of strategies? Are they looking at like family offices? It's more institutional. I mean, there's a broad range in that side. What kind of buyer is looking for this kind of platform and strategy mix?
We segment three segments. So we have high net worth individuals, qualified clients. These are qualified clients with 2.2 million and up. We look at the family office segment that generally starts at around, family office is such a broad category, but let's say between maybe 50 and maybe 250 million in assets, and then institutions are above that. There's gray areas, and each one you gotta treat with a certain amount of understanding what their needs are. At the qualified client and high net worth level, it's really just we're out there competing with a variety of alternative investments that they have, whether or not it's on angel list and they're starting to get involved in venture capital investing. Maybe their advisor is giving them some solutions from iCapital Network that has done a great job of fractionalizing or commoditizing large established managers. But we look at it saying, hey, if you've got a hard experience investing in alternative strategies and investing in investment managers, here's an easy way to do it. Because at the end of the day, everybody wants to be invested with the smartest people that they can, and to know that it's in your account, that it's in this fraudless environment, is what we see at the high net worth level. Family offices, it really depends on how much they see themselves as mini institutions. Do they have a mandate? Do they have a mandate that includes emerging managers? Obviously, we focus very much on those that have mandates for emerging managers, because of historically emerging managers have outperformed established managers. Really riding up folks that maybe start with about 150, 200 million AUM going up to that billion. Like, there's a lot of alpha, there's a lot of performance that you can do when niche strategies grow up. And, once you start hitting, 10 figures, sometimes the performance will flatten out. And so it's really just looking at, hey, how do we solve the need for new and competitive strategies, and investing with the smartest people you can on the kind of the lower, smaller end of that segment, to then, more professionalized tools of somebody who say, hey, how does ILPA do it? How can we replicate that type of diligence process?
Nice. I was actually talking to another NAAIM member this morning, and who does more institutional, and he was saying how his favorite niche or segment is the small endowments. and those kind of things. They act a little more like an individual, like a high net worth individual than an institution. Do you find that a niche that you guys are in, or maybe not so much?
Yeah, it's a broad stroke. So,
Sure.
investments we're talking about, MIT Investment Management Company has a really great, I wouldn't consider it small, but they have a very active emerging manager program. So it's more about understanding where they are in terms of how they look at modern portfolio theory, how they look at their approach to alternatives, how they look for alpha in their alternatives. So I don't know if I can segment it by like large or small,
Sure.
but more about mandates, and what the mandate is looking to do with the emerging manager portion of their hedge fund allocations.
Gotcha. I think what he was alluding to is that they tend just as people to act a little bit differently. Like they're not as some of the institutions are very, they'll analyze every little detail point, every little point, where some of these foundations are a little bit more just like a big family money, is investing this way, and they think about it a little bit differently.
Yeah, there's a lot to unpack there, but
Sorry.
one of our quips is, and for all the right reasons, but one of our quips that might apply to this, but at least in the family office space, when you've met a family office, you've met one family office. So like trying to put like broad stroke, generalizations about how family offices are similar, I think it's worthwhile, but it's also, you have to take it with a grain of salt. So, yeah, we focus on folks that are looking for smart people and want to do it in an efficient way, and then educate more and more of this market of what's the easiest way to identify talent.
Sure. We talked a bit about manager selection. When we were pre-talking for this, we were talking about AI as well. Is there any kind of angles that managers should be using for AI, or is that something more on your side of the world?
Well, I think, I am both kind of late to the game compared to my peers. I certainly have got folks that are in the tech space that are really on the cutting edge of everything that's happening and being implemented. And we kind of look back and say, okay, well, what are the applications that can really help ourselves and our business? So, for us, I don't know if we can look at our applications of AI as a marketplace, as being able to manage risk across a stable of strategies. If you've got allocations to 5 or 10 quantitative managers and you want to look at stable level analytics and correlations between them, machine learning does a good job of learning from trading activity and being able to forecast where, like, have much more precision in correlations and other things that can be picking up and optimizing that portfolio. But for the individual, I mean, I don't know. You have to be careful because sometimes you have laziness creep and start relying on a tool too much, and you rely on it so much that you're not have conviction in the content that you're putting out there, and it extends from being a tool to then being an actual extension of your voice. That's where you can be caught with poor rigor in the work that you're doing because you're regurgitating what may or may not actually be part of you. So it's like, think of it as a tool and apply it where there's a couple of great applications that AI really helps with, and ChatGPT is not the only one. Perplexity is really great as well, but a lot to see how this tool progresses and how it's probably going to get expensive for people that really love it.
Oh, absolutely. Well, then beyond AI, what other tools should investment managers be considering?
Yeah, sounds like plug time, but come take a look at us at Addigence, and would be more than excited to help anybody who's feels like they're having trouble in that between, say, 10 to 50 up to maybe 500 million in AUM, and they're trying to break out and get further distribution, make sure that the analytics that's going on to their process is at that institutional level and is digestible for both a generalist and sophisticated audience. We would love to be a partner. That's how we're set up. we built our business so that we're compensated when the clients do well. And if the clients do well, that means the portfolio managers are doing well. And
Right.
so it's very much we are partners in identifying and enabling investment into the next generation of great portfolio managers.
Nice. Well, it sounds like we covered everything along the way that you really help with, which is from, getting a strategy on a platform, doing the due diligence, finding a buyer for it. I mean, that's the hardest part really is finding buyers, because a lot of the managers don't have the time to get out and market. They just don't know people. Um, anything else that I'm missing on the path that you guys really help with?
Yeah, just thinking about it again from the client.
Sure.
Managing a whole bunch of relationships is just as taxing as the manager is managing a bunch of client relationships.
Oh,
So
yeah.
we're very bullish on being able to dually solve that. Hey, I'm trying to manage a whole book of business that a PM's doing across a portfolio manager's doing across all their clients, but then an end client, an allocator who's managing a book of allocations across a variety of different portals. So it's a two-way street, and nobody likes the steak dinners and the schmoozing and the 18-month cycle. So why do it? It's a brave new world. Nobody thought, when Uber was starting out, nobody thought somebody would go and, on their phone and hop into some stranger's car to get to where they're going.
Right.
Kind of a retail example for what we're doing, but similar
Yeah.
but different.
Like it. And I know certainly NAAIM is a place that you've found several good managers to have on your platform. Um, any insights onto that? I mean, from what I've seen, it's been a very diverse list that you have.
Yeah, we're only as good as our portfolio managers,
Right.
people who care about what they're doing, people care about, how they implement and exercise their expertise, being able to continue to have a platform of distributing that expertise and profiting off of it. So being able, we believe that there's a huge amount of opportunity in the sub $500 million space,
Yeah.
and anything we can do to enable discovery, but not just enable discovery, but actually enable that transaction.
Mhm.
Because just being a directory, just being like, hey, here's somebody who's interested in you, you manage that relationship, it kicks off, I don't know, 6, 8, 18-month sales cycle, and ain't nobody got time for that.
No, no, no. And I know several other NAAIM members, of course, who do the road shows, and they go to the speed dating things and all these events that you can go as a hedge fund manager, and you get like nothing out of it. You spend a lot of money to be there. You pitch in front of a lot of people, and you still almost never get something. So I think it's interesting that it's almost like a faster way to get in front of people that's more efficient, because it's people who actually are looking for you, not going through some process saying they did and not really caring.
Yeah, and there's no advantage of wasting people's time here on Addigence. It's
Right.
if this is something that you want to do, you implement it in your SMA. It's designed so that it's complementing your existing stable strategies or your investor profile on real-time basis. So
Right.
There's a lot of little solves along the way, and I want to go back to your mention. NAAIM has been sensational. Just a lot of really smart people, just brilliant people that are looking for distribution, and we just can't wait to be that bit of gasoline to be able to take them to the next level.
Yeah. No, absolutely. And I've been around the name community for at least 10 years at this point, and I've seen so many good managers who cannot sell to save their lives. They're great at money management, but they can't get in front of somebody. They can't even get that far. So it's neat to see because there's definitely a need there to fill that gap.
Different strategies have different nuances for how they get marketing.
Yeah.
Quantitative managers usually need a significant amount of help.
Yeah.
And so being able to be that conduit of how you take a highly quantitative strategy and look at it like, hey, if I want to know the most basic
Mhm.
things about how this work, I can do that. Or if I want to go in and drill down deeper and get more into the math because I have a math background as an allocator, we can be able to do both of that. We look at it kind of like the settings on your Apple computer. If you have an Apple computer where, hey, you might have something really basic. Hey, how do I go and, change my screensaver? Or how do I, be able to, fix my mouse? But hey, if you are specialists and you want to go in those advanced features, you want to go to the advanced analytics, Addigence is able to speak to both the generalist and the sophisticated, experienced audience.
Yep. Love it. Love it. I know we're getting kind of close to the end, but I think there's things we can add on from your quote. I was going to bring that up because I know I've got that ready for you. Slide. Boom. This is your quote. Actually, you can probably see it and I can't.
Yeah, David Swenson, Yale Endowment. Rest in peace. Unless institutions maintain contrarian positions through difficult times, the resulting damage of buying high and selling low imposes severe financial and reputational costs on the institution. We're building our platform, so it is a stable analytics management tool to being able to have batches of uncorrelated strategies. So somebody's always being able to be exposed to strategies that might be out of favor in a current regime, but certainly not in the cycle of just chasing what's hot. It's harder than it sounds, but it's something that is what best serves the client at the end of the day.
Right. And this quote is from the book from David Swenson, isn't it? I can't think of the book. I know I've read it. Like a portfolio manager, like guidebook or handbook or something like that.
A pioneering portfolio manager.
That's the one. That's the one. Any other insights that you got from that made this quote be your quote?
Short. Everything else is probably won't fit on one page. But
Nice.
I think yeah, people want to talk more about modern portfolio theory at the institutional level, and I'm available, Kenton at Addigence.com, and looking forward to continuing the discussion.
All right. Awesome. Well, any final words of wisdom while I have you? We've got about 2 minutes left.
No wisdom. Thank you, Ryan.
No wisdom.
Yeah, no, you guys rock, and we can't wait to be part of this. We can't wait to be a bigger part of this community, and have been so grateful for the acceptance and the true joy it is being at every conference. And we will see you in LA for Uncommon Knowledge.
In May 4th through 6th is what I've got noted, and I guess we'll see you there.
Be a good time.
And to ruin another surprise, you are going to be a host of this podcast starting next year. That is the rumor.
Be careful what you wish for, but yeah, we'll put screws to them. Yeah.
Love it, love it. So I think you'll be great. So it'll be great to have you as part of this group as well. All right, that's all we got. Great, Ken. Good to see you. Talk to you soon, and we'll see you next week on Name Confidential. Thanks,
All right.
everybody.